results?
Yeah, look, I think that's a real concern. I think when you see these types of moves, whether it's crypto or with regards to rates, I think the real concern is what the second derivative effect is.
Look, FTX is one of these absolute travesties in the history of financial markets. I mean,
People will lose billions of dollars collectively.
People are going to lose billions of dollars.
Peter Schiff, in his latest broadcast, addresses two major issues: the issue of inflation and the issue of leveraging in the financial sector as linked with FTX. Mr. Schiff dismisses the latest inflation report, which shows that inflation is on decline. Why does he think the drop in inflation rate is not worthy of applause? And are traditional financial institutions safe from crashes like that of FTX? Take a second to click the subscribe button for all your market and crypto analysis. Now, let's get down to today's video.
We also got news today from the Federal Reserve that we just had the biggest increase in household credit in 15 years, driven by mortgage debt and credit card debt. In fact, the increase in credit card debt is the biggest in 20 years. Household debt now stands at an all-time record high, $16.5 trillion. It's up $1.27 trillion in the last year. Again, a surge in household debt is not a sign of affluence. It's not a sign of a booming economy. You know, a lot of the newspapers that reported on this story online talked about the reason for this is strong demand. American consumers have strong demand, and so they're buying a lot of stuff, and they're running up their credit card bills. Well, if we had a strong economy that was behind that strong demand, consumers wouldn't need to use their credit cards to buy stuff. They would buy stuff with the money they earn from their jobs in a strong economy. The fact that consumers have to go into debt to buy shows they can't afford to buy the things they're buying. Now, I think one of the reasons they're going into debt to buy is because they're going into debt to buy food. They need to eat, and the only way they can afford to do it is if they charge it. So this is not a strong economy. This is a weak economy. And as I've explained many times, the evidence of economic strength is a rise in the savings rate. When people are more affluent, they have more savings. They pay off their debt. When times are tough, they dip into their savings and run up the debt. And that is exactly what we're doing right now. But what's also problematic about this surge in mortgage debt and credit card debt is that interest rates are also soaring. So in contrast to what Americans should be doing when rates are rising, which is reducing their debt, because then they would have a lower burden of servicing that debt, American households are going deeper into debt.
Despite inflation falling month after month since it peaked in June, the quality of life does not seem to be improving. As Peter Schiff said, households have seen its steepest ascent in 15 years. Credit card debts also rose by 15%, which is the highest it has risen in the past 20 years. These details were released by the New York Federal Reserve, and an official there made it known that the cause of this growing debt is consumer demands, which has remained high despite the high prices of commodities. According to Mr. Schiff, this demand is driven by shoppers that are bitten by economic realities. This contradicts the narrative that the economy is rebounding. He says in a thriving economy, people would not be taking more consumer debts. The surge in household debt is just an indication that the economy is not doing well. Therefore, the low CPI report is not yet worth celebrating. In Q3, household debt rose by about $351 billion, making the total over $16 trillion. This is the largest quarterly growth since 2007. Interest rates are high, which is an effect of the high rates from the Federal Reserve. Rates on retail credit cards are as high as 30% in some cases. With credit card interest rates this high, it would have been expected that credit card users would tone down on their card usage because of the high interest rate on the cards. Rather, usage has only been on a sharp increase this year. As the Federal Reserve raises interest rates, credit card annual percentage rates, a measure of the yearly cost of borrowing money, are climbing higher. That is especially true for retail credit cards, which tend to charge the most. The average annual percentage rate, or APR, across providers stands at 26.72%, and the highest cards charge a 30.74% rate, according to senior analyst at creditcards.com, Ted Rossman.
Many people in the financial community are now pointing to the collapse of crypto as an example of the thing that finally broke, because a lot of people were saying, hey, the Fed is going to tighten until it breaks something, and it finally succeeded. it broke crypto. And now they think, okay, now that crypto is broken, that's going to mark the low and we can rally. No, now that this link has broken, the entire chain is weaker and a lot more links are going to go. This is just like subprime blowing up. Everybody said it's contained to subprime. I said no, subprime was the weak link in the chain. The entire mortgage market was going to go. Well, that's what they're saying now. This is not contained to crypto. A lot of other industries are going to suffer. There's going to be bankruptcies because everybody was levered up. Crypto was simply the weakest link because crypto probably had the most leverage and the least real value. And of course, as FTX goes bankrupt, a lot of these firms that are connected with FTX are also going bankrupt. It was about 1 year ago today that Bitcoin hit its record high of 69,000. And as I'm talking now, it's about 16,800. So about a 75% decline. At its lows, I think it was down better than 77%. But what this collapse of FTX shows you is that that entire rally was a fraud, which is exactly what I said in real time. It was all the money that was spent to pump and then dump Bitcoin and other cryptos. But now we know where the money came from to pump it up. It came from stealing money from customers. In addition to leverage, there was no real demand there. There was no real widespread adoption. That's exactly what I was saying. It was all a giant Ponzi, a pyramid, a chain letter propped up by debt. I was watching a CNBC interview with Anthony Pompliano. He was being interviewed by Scott Wapner, and Scott actually was asking all these tough questions of Anthony Pompliano and asking him to accept responsibility for all the bad advice that he gave to investors on CNBC, for his constant touting of Bitcoin and how it was going to keep going up and how everybody should buy it and how it was a safe haven and a store of value, and then pointing to these huge losses and how much money people lost following his advice.
As Peter Schiff rightly pointed out, the collapse of FTX is not just the collapse of a crypto business alone. It's far-reaching and an insight into the danger of leveraging, which is not limited to crypto hedge funds and exchanges, but also prevalent in the traditional financial sector. It is already coming to light the involvement of several traditional financial institutions with FTX. Pension funds and many venture capital firms' involvements with the troubled crypto exchange has come to light. The major focus now is on the regulation of cryptocurrencies, but no one is talking about the impact this is having on institutional finance players such as SoftBank, which is a Japanese conglomerate, and the Ontario Teachers' Pension Plan that had all invested money in FTX. The takeaway here is we are not yet out of the woods. The economy is still precariously unhinged, and we may see a rebound of inflation if the Feds should ease too early. Subscribe and turn on the notification bell so you know when there is a fresh upload. Also, give this video a thumbs up to show your support for our content.